Hi everyone, my name is Jack, and I used to be like many of you, always dreaming of a secure financial future where money is no longer a worry. Imagine, you wake up every day without having to worry about the end of the month bill, about unexpected financial surprises. It's a dream that I've been pursuing for many years and once thought could never be achieved. I tried many ways, from individual stocks to investing in real estate, but the results mostly disappointed me. Sometimes I made money, but most of the time, I failed. Until I discovered an investment strategy that anyone can implement, investing in ETFs, exchange-traded funds. ETFs not only help me minimize risks, but also optimize profits effectively. This is no empty talk, as the numbers show that popular ETFs like the S&P 500 ETF have returned an average of 10% per year over the past 20 years, according to a report from CNBC. In this video, I will share with you the secret to investing in ETFs that anyone can apply, helping you build wealth and achieve financial freedom step by step. Don't miss the opportunity to change your life. Let's start this journey together. An ETF, short for Exchange Traded Fund, is a type of investment fund that is listed and traded on a stock exchange like a stock. Instead of investing in an individual company, an ETF allows you to invest in a diverse basket of assets, including stocks, bonds, commodities, real estate, and many other types of assets. This gives you access to many different sectors without having to spend time and effort choosing individual stocks or bonds. So what makes ETFs special? 1. Diversification. Investing in ETFs helps you reduce risk by spreading your money across a variety of assets. Instead of betting all on a single company, you're investing in a larger group of assets. This means that if one company in your portfolio struggles, the impact on your entire investment will be minimized. Number 2. Low cost. ETF management fees are typically lower than traditional mutual funds. Part of the reason is because ETFs are often passively managed, meaning they track a specific index rather than trying to outperform the market. According to Investopedia, popular ETFs like the Vanguard S&P 500 ETF have management fees of just 0.03%, while traditional mutual funds can have management fees of 1 to 2%. 3. High liquidity. You can buy and sell ETFs easily during the trading session, just like you would buy and sell stocks. This provides great flexibility, allowing you to quickly enter or exit the market when needed. Unlike mutual funds, you don't have to wait until the end of the day to know the value of your investment. 4. Transparency. Information about the ETF's portfolio is clearly disclosed and updated daily, so you know exactly what you are investing in. This gives you peace of mind knowing what assets you are holding in your portfolio. Here's a concrete example to help you visualize. Suppose you want to invest in the S&P 500 index, which includes the 500 largest companies in the US. Instead of having to buy individual stocks of each company, you can buy the SPY ETF, an ETF that tracks this index. By investing in SPY, you are investing in the entire S&P 500 market, helping you diversify and take advantage of the growth potential of the leading companies in the US. Another example is Vanguard's VTI ETF, which allows you to invest in the entire US stock market, from large companies to small companies. This gives you a more comprehensive view and can benefit from the development of the whole economy. In addition, if you are interested in other assets such as gold, the GLD ETF can be a good choice to invest in gold without having to store it physically. ETFs are really a great tool for those who want to invest smartly, safely, and effectively. Stay tuned for more ETF investment strategies that I have successfully applied. So what are the benefits of investing in ETFs? Investing in ETFs offers many attractive benefits. 1. Long-term asset growth. History has proven that the stock market always tends to grow in the long term. Investing in ETFs helps you take advantage of the power of compound interest to increase your assets sustainably. For example, the S&P 500 index has returned an average of 10% per year over the past 50 years. By investing in ETFs that mimic this index, you can benefit from the overall growth of the economy without having to choose individual stocks. ETFs not only provide asset growth, but also help you achieve long-term financial stability. The diversity of assets in ETFs helps minimize the impact of adverse events that may occur to certain companies or industries. This helps investors maintain the safety of their investment capital and still achieve good profits in the long term. 2. Save time and effort. One of the biggest benefits of ETFs is that you don't need to spend too much time researching and choosing stocks. ETFs are a passive investment tool, tracking indexes such as the S&P 500, NASDAQ 100, or specific industry groups. This means that you just need to choose the right ETF and let it do its job. With ETFs, you can invest in a diverse portfolio of stocks without having to worry about researching each company. For busy people, being able to invest passively and not having to monitor the market every day is a huge benefit. You just need to set up a regular investment plan and let the ETF do the rest. This not only saves time, but also helps you minimize emotional mistakes when investing. Number 3. Suitable for everyone. ETFs are an ideal investment option for both new and experienced investors. If you are a beginner, ETFs provide an easy way to access the market without having to have a deep understanding of each company or industry. If you are an experienced investor, you can use ETFs to diversify your portfolio, adding industries or regions that you have not invested in. ETFs also make it easy for retail investors to participate in large markets that they may not be able to invest in directly. With a small amount of money, you can own a part of leading companies through ETFs, instead of having to have enough money to buy stocks of each company individually. 4. Flexible. Another benefit of ETFs is their high flexibility. There are many different types of ETFs, from those that track stock indexes, to those that invest in commodities such as gold, oil, or even high-tech industries. This allows you to choose an ETF that fits your financial goals, risk appetite, and investment time horizon. For example, if you want to invest in leading technology companies, you can choose QQQ, an ETF that focuses on the Nasdaq 100 index, which is home to technology giants like Apple, Microsoft, and Amazon. First, you need to have a stock trading account. This is where you'll actually buy and sell ETFs. You can open an account with reputable brokerage firms like Charles Schwab, Vanguard, Fidelity, or Robinhood. Opening an account is easy and can be done online in just a few minutes. Most brokerage firms require some basic personal information, like your social security number, address, and personal financial information. When opening an account, consider choosing a brokerage firm that has an easy-to-use interface, low or no trading fees, and offers investor support tools like analytical reports and investment guides. For example, Fidelity offers a lot of learning resources and support for beginners, while Robinhood is known for its free trading and user-friendly interface for younger users. Step 2. Choose the right ETF. Next, you need to choose an ETF that fits your investment goals. This is a very important step because it directly affects your investment results. You should consider the following factors. Determine your investment goals. Are you investing for long-term asset growth, capital preservation, or additional income from dividends? This goal will determine the type of ETF you should choose. For example, if you want strong long-term growth, technology ETFs like QQQ may be suitable. If you want capital preservation, consider bond ETFs like BND. Risk appetite and investment time horizon. ETFs have different levels of risk, from safe ETFs like bond ETFs to high growth, but riskier ETFs like technology ETFs. If you're willing to accept high risks for high profits, growth ETFs are the right choice. On the contrary, if you do not want to face many fluctuations, choose ETFs with low risk. Management costs. You should choose ETFs with low management costs. ETF management fees are one of the factors that affect your returns over the long term. A small annual fee can add up to a significant amount over time. Look for ETFs with low expense ratios, such as the Vanguard S&P 500 ETF, which has an expense ratio of just 0.03%. ETFs also allow you to flexibly change your portfolio as your financial situation or investment goals change. For example, when you're young, you can choose high-growth ETFs that focus on technology companies. When you are older and want to reduce risk, you can switch to ETFs that invest in bonds or more stable industries. 5. Low cost. As mentioned earlier, ETF management costs are often very low compared to mutual funds. For investors who want to maximize returns, minimizing costs is an important factor. A small fee can make a big difference in the long run thanks to compounding. According to research from Morningstar, ETFs typically have an average management fee of less than 0.5%, allowing you to keep more of your money invested. Additionally, many ETFs do not charge a trading fee, which saves you money on trading. This is especially important for investors who buy and sell frequently or make recurring investments. Any reduction in fees will increase the amount of money you can invest and accumulate over time. Room 6. High liquidity and ease of trading. ETFs trade like stocks on the stock exchange, which means you can buy and sell them at any time during the trading day. High liquidity allows you to quickly convert your investment into cash when needed, or quickly take advantage of other investment opportunities. This is a big advantage over mutual funds, which can only be traded once a day after the market closes. With ETFs, you can react quickly to market fluctuations and adjust your investment strategy in a timely manner. For example, if you want to invest in the technology sector, the QQQ ETF is a popular choice. QQQ tracks the Nasdaq 100 index, which includes major technology companies such as Apple, Google, Amazon, and Facebook. By investing in QQQ, you are not only investing in a single company, but also in the entire technology sector, an industry with huge growth potential. Alternatively, if you want to invest in international markets, you can choose an ETF like VXUSUS, an ETF from Vanguard that tracks international markets outside the US, helping you diversify and gain access to investment opportunities globally. This allows you to not only rely on the growth of the US economy, but also benefit from the growth of emerging economies. To start investing in ETFs, you need to follow these steps. Step 1. Open a stock trading account. Portfolio. Make sure the ETF you choose invests in assets that align with your goals. If you are interested in the technology sector, choose an ETF that focuses on that sector. If you want to invest in international markets, look for ETFs that invest in foreign stocks. Performance. Compare the performance of the ETF to its benchmark index or other ETFs in the same category. This will help you understand how well the ETF is performing. Step 3. Place an ETF order. Once you have selected the appropriate ETF, you can place an order to buy the ETF through the brokerage firm's online trading platform. The steps to place an order are simple. 1. Access your trading account. Log in to the securities trading account you opened earlier. Each platform will have a slightly different interface, but most are quite intuitive and easy to use. 2. Search for the ETF you want to buy. Use the platform's search tool to find the name or symbol of the ETF you want to invest in. For example, if you want to buy the ETF SPY, enter the code SPY in the search bar. 3. Select the quantity and type of order. Determine the quantity of ETF you want to buy and the type of order you want to place. You can choose a market order to buy the ETF immediately at the current price, or a limit order to buy at a specific price you want. 4. Confirm the transaction. Double-check the transaction information, including quantity, order type, and price. Then, press the Confirm button to execute the purchase order. Usually, your order will be executed immediately if you choose a market order. After purchasing, the ETF will appear in your portfolio and you can track its performance through the trading platform. It is important that you keep a long-term investment plan and not be too affected by short-term market fluctuations. Step 4. Monitor and adjust your portfolio after purchasing an ETF. Your work does not stop there. You need to regularly monitor your portfolio and adjust when necessary. Check whether your ETF is performing well and meeting your investment goals. If not, it may be time to change your strategy or switch to other more suitable ETFs. For example, as the market changes, or as your financial goals change, say you want to reduce your risk as you approach retirement, you can switch from stock ETFs to safer bond ETFs. Adjusting your portfolio periodically helps ensure that you stay on track with your financial goals. Investing in ETFs is really simple and accessible. With just a few basic steps, you can start your investing journey. The most important thing is to maintain discipline, patience, and continuous learning to achieve the best financial results. After purchasing an ETF, portfolio management is the key to ensuring that you achieve your long-term financial goals. To effectively manage an ETF portfolio, you need to focus on the following factors. 1. Asset allocation. Diversification is one of the most important principles in risk management. Invest in a variety of ETFs to minimize the risk of any particular asset class. You can allocate your assets across stock ETFs, bond ETFs, commodity ETFs, and real estate ETFs. For example, you can allocate 60% of your assets to stock ETFs like SPY or VOO, and 40% to bond ETFs like BND to balance risk and return. Asset allocation not only helps you minimize risk, but also optimize returns over the long term. You can also allocate your assets based on your personal investment strategy, such as a growth strategy or a capital preservation strategy. 2. Rebalance your portfolio. As the market fluctuates, the asset classes in your portfolio may change and no longer reflect your original investment strategy. For example, if your stock ETFs increase dramatically, the proportion of stocks in your portfolio will become larger, leading to a higher level of risk than originally planned. To maintain the desired level of risk, you need to rebalance your portfolio periodically, usually every quarter or every year. Rebalancing can be done by selling a portion of the ETFs that are overweight and buying more ETFs that are underweight. This process helps maintain a portfolio structure that is consistent with your financial goals. 3. Periodic investing. Periodic investing is a smart strategy that helps you accumulate assets regularly and avoid the risks of investing during unfavorable market times. By setting aside a fixed amount each month to buy more ETFs, you can apply the dollar cost averaging method, which helps minimize the impact of price fluctuations in the market. For example, you could set aside $500 each month to buy a stock ETF like VTI or QQQ. This allows you to maintain investment discipline and accumulate assets effectively, regardless of whether the market is rising or falling. Over time, this periodic investment strategy can help you achieve better returns than trying to buy the bottom or sell the top of the market. 4. Track performance and adjust strategy. Tracking your portfolio performance is essential to ensure you are on track. Use analytics tools like Morningstar or Yahoo Finance to check the performance of your ETF holdings and compare them to the benchmark index. If an ETF is not performing as expected or is no longer aligned with your financial goals, you may need to adjust or replace it with another ETF. Tracking performance not only helps you make timely adjustments, but also helps you learn important lessons in investing. You should review your portfolio at least once a year to review your financial goals, whether your risk level is appropriate, and whether your ETF holdings still meet your long-term goals. Managing an ETF portfolio is an ongoing process that requires discipline. Proper asset allocation, regular rebalancing, regular investment, and performance monitoring will help you optimize your portfolio and achieve your long-term financial goals. Remember, successful investing is not just about choosing good assets, but also about being able to manage them effectively and consistently. Although ETFs offer many benefits, there are certain risks. 1. Market risk. The value of an ETF can fluctuate with the general market. When the market declines, the value of your ETF will also decline. This is an unavoidable risk when investing in products related to stocks, bonds, or commodities. 2. Inflation risk. Inflation can reduce the real value of assets. If inflation increases sharply, the return from an ETF may not be enough to offset the increase in the price of goods and services, causing the real value of the investment to decrease. 3. Liquidity risk. Some ETFs may be illiquid, especially those that invest in small or underdeveloped markets. This means that when you want to sell your ETF, you may not be able to find a buyer, or you may have to sell it at a lower price than expected. To avoid risks, you can take the following measures. 1. Long-term investment. Avoid short-term investment in ETFs, as ETF values can fluctuate sharply in the short term. Long-term investment helps you take advantage of the stable growth of the market and avoid unwanted short-term fluctuations. 2. Diversify your portfolio. Diversification is the key to minimizing risk. Allocate your capital to different types of ETFs, including stock ETFs, bond ETFs, real estate ETFs, and commodity ETFs. This helps you minimize the risk when a particular asset class encounters difficulties. 3. Do your due diligence before investing. Before investing in any ETF, do your due diligence on the fund, its portfolio composition, and its past performance. Make sure you understand the asset classes the ETF is investing in and the risks associated with them. This will help you make more informed investment decisions and avoid ETFs that are not suitable for your financial goals. Investing in ETFs offers many opportunities, but it is important to understand the risks and take precautions. Always remember that no investment is completely risk-free, and the most important thing is to be mentally and strategically prepared to deal with them. Investing in ETFs is an effective way to build wealth and achieve financial freedom. The benefits of ETFs, such as diversification, low costs, high liquidity, and flexibility, make ETFs a great investment option, suitable for everyone from beginners to experienced investors. The important thing I want to emphasize to you is to start today, even with a small amount of money. There is no need to wait until you have a large amount of capital, because a journey of 1,000 miles always begins with the first step. ETFs help you build a solid foundation and accumulate gradually towards your long-term financial goals. Remember, 1. Persistence. Investing is a long-term journey, and there will be ups and downs along the way. Don't be discouraged by short-term fluctuations in the market. History has proven that stock market growth is a long-term trend, and persistence is the key to success. To avoid risks, you can take the following measures. 1. Long-term investment. Avoid short-term investment in ETFs, as ETF values can fluctuate sharply in the short term. Long-term investment helps you take advantage of the stable growth of the market and avoid unwanted short-term fluctuations. 2. Diversify your portfolio. Diversification is the key to minimizing risk. Allocate your capital to different types of ETFs, including stock ETFs, bond ETFs, real estate ETFs, and commodity ETFs. This helps you minimize the risk when a particular asset class encounters difficulties. 3. Do your due diligence before investing. Before investing in any ETF, do your due diligence on the fund, its portfolio composition, and its past performance. Make sure you understand the asset classes the ETF is investing in, and the risks associated with them. This will help you make more informed investment decisions, and avoid ETFs that are not suitable for your financial goals. Investing in ETFs offers many opportunities, but it is important to understand the risks and take precautions. Always remember that no investment is completely risk-free, and the most important thing is to be mentally and strategically prepared to deal with them. Investing in ETFs is an effective way to build wealth and achieve financial freedom. The benefits of ETFs, such as diversification, low costs, high liquidity, and flexibility, make ETFs a great investment option, suitable for everyone from beginners to experienced investors. The important thing I want to emphasize to you is to start today, even with a small amount of money. There is no need to wait until you have a large amount of capital, because a journey of 1,000 miles always begins with the first step. ETFs help you build a solid foundation and accumulate gradually towards your long-term financial goals. Remember, 1. Persistence. Investing is a long-term journey, and there will be ups and downs along the way. Don't be discouraged by short-term fluctuations in the market. History has proven that stock market growth is a long-term trend, and persistence is the key to success. 2. Continuous learning. The world of investing is constantly changing and evolving. To be successful, you need to constantly update your knowledge about investing, new trends, and useful financial tools. Read books, take online investment courses, or follow YouTube channels like mine to learn more. 3. Actively manage your investment portfolio. Regularly monitoring and adjusting your investment portfolio helps you stay on track and adjust when your financial goals or the market change. This may include rebalancing your portfolio to maintain your planned asset allocation, or adding or removing new ETFs to suit your current situation. Additionally, long-term thinking is key to success when investing in ETFs. Set specific goals for the future, whether it's saving for a home, saving for your children's education, or preparing for retirement. ETFs are a tool to help you get closer to those goals by providing sustainable growth and preserving capital value over time. Never forget the power of compound interest. Albert Einstein once said that compound interest is the 8th wonder of the world, and investing in ETFs is one of the best ways to take advantage of this power. By investing periodically, your profits will continue to earn and grow over time, helping you move towards financial freedom quickly and safely. Apply the knowledge you have learned in this video immediately. Don't let theories become meaningless because you don't take action. Every small step today will be a solid foundation for your financial freedom in the future. I'm excited to hear about your investment journey and hope that these shares can help you on that path. Don't forget to like, share and subscribe to my YouTube channel so you don't miss new videos on smart and effective investment strategies. Your likes and shares not only help me, but also help many other people gain more knowledge to improve their financial situation. Thank you very much for taking the time to watch. Wish you success and see you in the next videos.